Welcome everyone to this new talk. Today, the subject that we're going to address is the SDGs, how to draw the guide on financing towards peace. Our guest speakers today are Agi Veres, Director of UNDP Geneva, and Karen Wilson, Founder of Global Venture Partners. They will be properly introduced by Cécile Molinier. I just would like to set a little bit the stage with a few personal comments. Since you know I am an actuary, I have been working in financial issues my whole life, and I am convinced that there's a kind of mystification and even a contradiction. Each time that we see the world financing in any title, we think that things are clear, that numbers are numbers, and that there is no problem. On the other hand, there is a perception that financing is for specialists, not for everybody. And at the end of the day, we all have to deal with this. And I would just like to share a few issues that were mentioned just last Friday in Geneva. Like, you know, Geneva is a very incredible ecosystem, and there are more than 600 meetings taking place all over the year. We, at Great Cells, we participated in 4 meetings last Friday. And all of them are related to the subject that is going to be addressed today by Agi Veres and Karen Wilson. The first one was the Gender Champions meeting. And the takeaway I got from there is that you have to have a focus, and things do not happen by accident. If you want to target women, there has to be a focus on women. If you in your financing, if you want to target older people, there has to be a focus on that. You want to target people in agriculture or in the informal economy or handicap. There has to be a purpose, and they have to be targeted. Grace has also participated at the closing ceremony of the Geneva Peace Week and the coffee and address by Filippo Grande. And their financing was at the center of the migrants and refugees issues. And the takeaway was who pays, who benefits, and when. The payment has to be done, and who's going to be benefiting from it. The 4th meeting that Grace attended last Friday, the 3rd meeting, was on armed conflicts. And their financing was really at the center of the discussion. What is the cost of all these problems and war conflicts all over the world? And more importantly, what is the shadow price of spending money in arms and not in development? And that was really all over the meeting. And the last meeting that Grace attended last Friday was with Guy Ryder, Undersecretary General for Policy on the Summit for the Future. Of course, he mentioned something that's going to happen on the discussions that will take place next September at the Summit of the Future. But financing and sustainable financing was, of course, there were 2 common issues, and I will be just brief. Common issue that came out in every meeting is that we have the means, we have the capacity, but the big question is if we have the will. And there's a second common issue. Spreading the word is not enough. We have to be we have to be deliberate and realistic so that we get as close as possible to a sustainable win-win situation. And that means negotiating and diplomacy in financing. So with these introduction elements, and without further ado, I would give the floor to Cécile Molinier, who is member of the Executive Committee of Great Cells and former director of UNDP Geneva. Cécile, the floor is yours.
Thank you very much, Alejandro, for setting the scene and for giving me the floor. As moderator, I will introduce very briefly our 2 speakers, Agi Veres and Karen Wilson. I will then give them the floor for an exchange which should last about 40 to 45 minutes overall, and then the floor will be open for questions. We have participants here physically in Geneva and a number of participants online. So, Agi, you have been the director of UNDP Geneva, I believe, for a couple of years. And before you came to Geneva, you were the deputy regional director for Europe and Central Asia. And before that very important position at headquarters, you were in the field in a couple of very important locations, China, for several years. And before that, you were in Lesotho. And before joining UNDP, you worked in the private sector as a management consultant. And you, Karen, you've worked in a number of places, public, private. You teach in a number of leading universities, worked at the OECD for 12 years, and serve currently on the board of a number of very prestigious institutions focusing on impact financing and sustainable financing, which is, of course, going to be the topic of our conversation. So without further ado, Agi, you have the floor.
Thank you very much, Cecilia. It's a pleasure to be here. So perhaps before I start talking about the global financial architecture and in general about the SDG financing, just to say that the purpose of this talk is a little bit different than our usual interactions on financing. Myself, Karen, and many others, we have been in these discussions for years. And what I realize oftentimes is that we meet between the public sector and the private sector, and we acknowledge we don't speak the same language. So over the years, we're coming closer and closer in understanding of what we're each trying to achieve. And then the other realization is that there are so many interested parties out there who would like to know more about the topic. They feel it's a very technical discussion. So the point of today's discussion is really to demystify it a little bit and to turn a technical discussion into kind of a tangible dialogue on what is that we're talking about and why are we talking about this. And what does, for example, a development agency like UNDP have to do with it? We get this question often actually from our partners. You're in development. You should be focusing on poverty. You should be focusing on climate. Why are you involved in financing? So I want to start with that, actually, because the two are absolutely and completely connected. You cannot talk about achieving the SDGs without talking about financing. According to the latest studies that were just discussed in New York at the various high-level meetings, 15% of the SDGs are on track right now. So if we are far behind on poverty, education, decent work, and climate action, it's in part because we are consistently behind on finance. If we're not aligning where the investments are going, we're not going to get a different output. We have passed the era when development was about grants and getting donor funding and this UN agencies going there and spending their own funds. It's just simply not enough to turn the tide. So we are attempting a very transformative agenda. We're trying to achieve the SDGs, but we're trying to do that with old tools and old style approaches, out-of-date policies, regulations, institutions, and investment incentives, both on the public and the private finance. So the idea is how we can all bring all of this together, because we're not short on funds. The world has over 450 trillion in assets. Less than 1% of this, 3 trillion a year, would be enough to achieve the SDGs and the climate goals in all of the developing countries, set aside China. So that means the money is there. It's just not necessarily going to address these issues. So I wanted to give you a few statistics of what's wrong with the distribution and what are the inequalities that we're trying to address. And then I'd like to talk a little bit about what does the financial architecture have to do with it. So as many of you know, UNDP is well known for our human development reports and the Human Development Index that we issue every year. And for 2 years in a row now, the poverty is actually back increasing. The Human Development Index is going down. And it's not like in previous times when we could point out in a certain countries, regions connected to climate. It's going down everywhere, the whole set. So we really need to stop and think, what does that mean and why we're in this situation? A few numbers. The richest 10% of the global population takes 52% of the global income, where the poorest half of the population earns 8.5%. Now, if we look at the global wealth, these inequalities are even more pronounced. The poorest half of the global population possesses just 2% of the total wealth. In contrast, the richest 10% possesses 76% of the global wealth. when we look at the ecological correlation of this, it's actually following the same patterns. Inequalities in CO2 emissions at the world level show that the top 10% of emitters are responsible for close to 50% of these emissions, while the bottom 50 produce only 12%. So we can see that this income disparity and emissions is reflected in every world region. So there is a connection with where the wealth is and how we can relate that, just as an example, to climate policies. So when we look at why, for example, taking the climate agenda is not moving, because climate policies are pulled back by societies. So essentially, we find that in many places, the poor are supposed to be paying for those climate policies, and then politicians push back on the right things to do because they are being pushed back by their societies who are not necessarily ready to take that up. So what that means is that we really need to understand that part of the reason why the climate discussion and the whole biodiversity conservation discussion is not taking up as much as we want, because the social issues are not addressed. So again, everything is interlinked. We can't just say that we need to go ahead with decarbonization, with green energy and so forth, if the social policies are not in place that would allow that burden in terms of paying for it to be taken in a different way, and not burdening the parts of the world, developing countries, and parts of the societies, the poorest, to pay for it. So there's a need then for finance shift. So looking just at these numbers that I mentioned and the wealth out there, we could say just shift the numbers, just there's enough money for everyone. So what needs to be done? So three things need to happen. First, we need to align more money to sustainable development from all sources. But it's not that easy. You can't just tell banks, governments, and others to align their money. There needs to be some processes around it. Second is the quality of finance. So we have to improve to reach the highest development return on investment. It matters what we invest in and what that quality gives us. And third, developing countries really need a greater support in developing their own capacities to attract more of these higher quality investments, to provide a lower risks for investments and so forth. And just a caveat to these 3 points. When the world needed to find money, some countries were able to find that money. If you consider the COVID response, OECD countries found $11 billion for mitigating the effects of COVID, while developing countries were left behind. We found ways of reducing our energy consumption, and when the energy crisis hit hardest a little while back. So why can't we find these finances when we're not under the gun, when we're not pressed, when we're not in a crisis? Why can't we find and align those? So now I just want to give you an overall picture of what are some of the issues when it comes to the global financial architecture. I mean, first of all, I think we need to understand what we're talking about. When we talk about the global financial architecture, it's the whole system. It's Bretton Woods institutions, the banks, the World Bank, IMF, it's the whole way the banking system works, it's the taxation, how loans are given to at the level of national entities to governments, how the financing investments are flowing across the globe. And we do live in a globalized world, so some of it can be nationalized or localized, but a lot of it is interconnected. So this system was created in 1945 after World War II under a completely different context. So at this time, we were not talking about climate change, gender inequalities. We were not really looking at systemic risk, inequalities, all the crises that's happening now, the dramatic demographics that are happening across the world, technology, digitalization, AI. It was not there. So we're living with a system that was set up in a completely different era with completely different incentives. We're surprised that this system no longer works for us. So I think that's where we need to start with our understanding. When you're trying to have a system work for the SDGs, then we need to look at what is inherently behind this system, how it's incentivized, and what are the governance mechanisms. So this global financial system is actually looking at more of a perspective of risks to lenders over risks to people. Because when we're talking about the SDGs, it's about advancing human development, sustainable human development. When we talk about financing, we're talking about risks a lot. And my friend Karen, hopefully, will talk a lot about that when it comes to the investments at the more micro level. So we need, and I think, this is also a discussion that many of you hear out there, is that we need to come away from a growth model. We need to stop measuring in GDP. But what does that really mean? It just simply means that, if we are just measuring our economies, our investments, our success by a rate of return, by the growth that it's generating, we are not considering the other factors that really matter in terms of the quality of what this is all generating. Is this a growth that is just creating more wealth, or is this a growth that's creating kind of a sustainable investments into our societies? And then lastly, one of the key underlying problems in this system that we call the global financial infrastructure is that, we created a situation of loans and borrowing of monies to invest in certain things. But where we are now today is that there is such a high borrowing cost for developing countries because of the risk factor, because of many factors that I don't necessarily want to go into the technicalities. What that means is, just as when you're borrowing money from your bank, you have to meet those expectations. You have to pay your share every month. And that means if that is proportionately large in terms of your overall available resources, then you're not going to be able to go travel or to do something else. So it's the same. This debt servicing, we call it the debt servicing that these countries are doing. Just to give you an idea, the average low-income country spends about 2.3 times more on interest payments than on social assistance, and 1.5 more than on healthcare. So what this means, the fiscal space, the available resources that developing countries have to invest in their own development is very, very limited, because they have to pay their debts. They have to service their debts. So there are these inherent inefficiencies in the systems, and it would take, of course, a lot of efforts when we're talking about reforming the system. It's not tweaking it. And that's the difficulty. When we look at the meetings of the financial institutions, or the Paris Financial Summit, or the G20 discussions about sustainable finance, one of the underlying issues is that when you have a certain governance mechanism for this system that's underrepresenting those who we want to have the most, especially developing countries, it's very difficult to reform a system from inside. Because inherently, you're giving up your seat and your voice to have the voice of others that may have a different interest from you. So, of course, that is the number one issue when we're looking at these reforms. So the inefficiency of the system is evident in many ways in some of these numbers. The access to liquidity to resources is, as I mentioned, one of the problems. But it's especially the impact of it is the dramatic underinvestment in global public goods, including in pandemic preparedness or the climate action. And as countries are heavily focused on growth, jobs, and poverty reduction, it's increasingly difficult for them to address not just the let's say, predictable development issues that they have, or the development issues of the day, but really the shocks that we're experiencing in the pandemic times, with crisis, with cost of living crisis, and so forth. So when you have no fiscal space to start with, and then you have to respond to these shocks, it's really putting you in a very, very tight situation, especially when it comes to developing countries. One additional aspect to this is, for example, looking at the tax systems. The international tax architecture has not really kept pace with the changing world. So while countries ultimately need to rely on their national resources, taxes they collect to finance investments in their own sustainability, global tax evasion and avoidance that's happening on the tax collections is also contributing and adding pressures to that. So, I think we talk a lot about these problems, but I want to focus a little bit on what are the ambitions, what is that we're trying to achieve, because we do see a way out of it, but it's not easy. It's very challenging, partially because the global governance around it, partially because the inherent conflicts between the politicians' short-term focus on elections and their ability to then have long-term policy changes, partially the financial markets that really have a difficulty in general to internalize externalities. So there's a lot of issues out there that makes it very difficult. But what we need to do is actually there are a number of priorities that if we advance systematically, that they will really bring a change. So number one is aligning the national financing strategies with the SDGs. This means that not just on public finance or on private investments, but really everywhere. So moving the easily movable money is not enough. We really need to align all forms of finance, from very simple things of what we spend on groceries, how we are consuming and producing, and how the financing investments are going into that, the choices made by the finance ministries and the CEOs, public and private, micro and macro. So that's a big ask. However, we do have a few good ways forward. First of all, the public sector realization that this needs to change is already a fantastic way forward, because only the public sector can really serve the purpose of being fiduciary of global public goods. So to achieve the SDGs, government really must have the robust institutions, the right policies to incentivize others around them as well. One of the key tools in the toolbox that we see are working is the so-called integrated national financing frameworks. As UNDP, we are a leading partner in doing that together with, of course, many other partners. What this really means is working with governments to look at how are they aligning not just their public finances, but their policies towards the areas where are needed. And essentially, it's a planning and financing channeling tool, depending on the development needs of the country. Some countries may want to invest more in climate, others in digitalization. But if you're not aligning your public financing, your budgeting, your planning and policies, then the money is, of course, not going to flow there. So this is a very, very good tool with fantastic results. Now we have underway in 86 countries. And they really are supporting now over 250 reforms that comes at the national level that allows these countries to channel the funding. Just to give you an example, in 2022, through this budget tagging approach in Colombia, ensured that spending aligned with the SDGs rose to a total of $65 billion. This was a $4 billion increase from 2021. In Uzbekistan, in Central Asia, as another region, SDG-aligned spending rose to 14 billion in 2022 and increased 3 billion over the previous year. So we can see tangible, quantifiable ways of how this goes. Then the number two kind of ambition way going forward is define new means to mobilize finance. And this is where I hope, Karin, you will also come in on this to see how we are mobilizing finance and what that really means. I mean, partially it's at the national level and it's an opportunity shift. So one way is to look at existing debt and look at the large shares of current debt that are maturing and we require refinancing. So what does that mean? Low-income countries will see about 45% of the outstanding debt to be matured in 2024. So this is a good moment because this coincides with the emergence of new generation of different financing instruments. What that means is that they can, for example, change their existing debt to a different kind of investments. And there are a lot of examples of issuing bonds that support sustainable agendas. So when we're looking at mobilizing new finance, it's mobilizing new finance using new financial instruments for investments, but also to change existing commitments out there to different kind of commitments. There are, again, very good examples. To quote a few from different regions, again, Mexico issued the world's first sovereign SDG bond for 750 million euros, followed by a second for 1.2 billion euros. Indonesia has issued sovereign green Islamic bonds worth more than 6 billion and SDG bonds for more than 1 billion. So what that means is that we're inserting that quality and the output we're looking for into the financial instruments that are providing the financing space. The third one, in terms of our way forward, this is really about developed roadmaps and standards, including for the private sector. And I will touch upon this at the high level because Karen has a lot of experience with it, and I think several of you in the room may want to contribute to that. So this is a really, really good moment because there are shifts in the thinking of the market, private sectors, the finance sectors of what is a sustainable investments. And we as UNDP, we're trying to do is look at why are these investments, private investments, are not happening in developing countries, for example, as our main concerns as a development agency. I mean, partially it's because of the perceived or real risk, but a lot of the time it's more perceived than real. So investors are just afraid of unknown regulations, markets, they don't know where the investments go. And also countries themselves are not necessarily able to articulate properly where the investment should be going. So wherever the investment comes, it's welcome, the more the merrier, rather than trying to channel them. So we have now been working in 34 countries and it's growing all the time, the so-called SDG investor maps. So what that means is we as an international organization with no agenda, no profit orientation, working with the governments that we naturally work with, we have a pretty good idea of what are the development areas in these countries. In certain countries, it's really about health or access to energy. So we need to tie that down to how that looks from an investor's perspective. Where is the pipeline, as the finance community calls it? Where are the projects we can invest in? So we looked at 550 investment areas, and it's a business and business model behind it, where basically we're saying, in 3x, let's say in Armenia, the needs for investments are really in the area of health. And the opportunity for investments to these needs is, for example, in telehealth services. And then we kind of help the private sector and the financial sector to remove some of the work that they're not necessarily willing to invest, analyzing the return on investment, the risk factors, the areas for investment, so that it's easier for market entry for this. And there are many other tools similar to this that essentially is trying to encourage and incentivize private investments, and looking at some of the standards of what is that actually can be called sustainable investments. And there's a whole debate out there, of course, about green washing, blue washing, green investments, sustainable financing, and so forth. Then lastly, in terms of the way forward and what we can do to advance on this issue is the risk development to improve the lives and reduce the costs. So what this means is that a lot of the work ahead of us, it's about the concerns about risks and resilience. So there's a lot of fragmentation, a lot of lag for development because of conflict and crisis. So what we are looking at is how we can work with these countries and bring in some of the accelerators that could address these issues, such as, for example, looking at digital solutions. We have been working in 124 countries on digital solutions that puts an increasing emphasis on establishing digital public infrastructure in lower and middle income countries, and put that fusion into the economy. Alejandro started by putting emphasis on women. That's in particular the benefits when we're investing in women-led enterprises, or in general, the development of skills, participation at the job market of women. That brings a lot of benefits as well. So, again, there are, of course, various tools, and the main point is that it's a system that needs reform, but the system, of course, is made up by certain parts of it. So we need to do both. We need to look at collectively, as global institutions and organizations and governments, of how the system can be reformed, but we also need to look at the parts of the system and try to see what we can do today, now, that will change the conversation, that will attract the financing to go where it's needed. And that we're really looking at not just the growth we get, because the situation we have today, it's a growth we get. It's fossil fuel driven, it's commodity based, it's debt fueled and frequently unjust. But to go to the development we want with the investments that accompany it, that expands human and planetary well-being, creates jobs and accelerates energy transition, all at the same time. So it's not a small ask, but it's also not impossible. And I'm really looking at all the efforts that are going on this. And I think if you have better understanding from people in the everyday life, what they can do at their level, private sector institutions, banks, governments, and then, the big intergovernmental organizations, that's the only way this will be addressed. But with that, I really wanted to leave time for Karen to reflect on this, because a lot of the details are at the private level, and I'm sure you have a lot of reflections on this to see how that's progressing from where you see it.
Yes, thank you very much, and thank you for laying out the scenarios so well. I will focus on private sector financing, but actually I wanted to start by addressing a number of the good points excellent points that you brought up. And first, I just wanted to say that the SDGs have really been an important framework to help when you talked about the public and private sector and having different languages. And I think the SDG framework has really helped connect the public and private sector to better understand each other and better understand what the needs are. So really, kudos to the UN. No one remembers the MDGs outside of the international organizations, but everyone's excited about the SDGs and linking to it. You see it on corporate reports. And so I think it's really progress that has really raised awareness and helped create that language, because understanding each other and having the language is the first step to collaboration, which is essential if we're talking about leveraging more money. You also talked about the fact that there's a lot of money. Yes, there is a lot of money out there. And the issue has been for quite a long time, the money is not going where it's most needed. And I want to come back to that because you touched upon a number of key challenges that I want to dig into further. We do have a lot more tools, and I'm also going to talk about some of the financing tools that are out there and what they can do and what they can't do. But I also wanted to come back to your point about GDP. I think it was maybe a decade or more ago that economists first got together and said, actually, we have to measure more than GDP. There was the Stiglitz Commission or Sarkozy Commission or whatever you want to call it. It was in 2009. OECD was heavily involved and was then commissioned to develop this well-being framework. Stiglitz went on to create the happiness index. But I think that was the beginning of, and maybe not the beginning, because I know UNDP has been working on the Human Development Index for a long time, but it was the beginning of the bringing together of these different efforts to recognize that we have to think about more than just GDP and just finance. We have to think about these interrelated issues, how they're connected, and how we account for that. You talked about pricing the externalities. Until we're doing that, behavior is not going to change. So, as the former chief of staff at OECD used to say, measure what you treasure, don't treasure what you measure. And the problem is we also often treasure what we measure because that's the data we have. But we have to figure out what data do we need to really get to the kind of the world that you're talking about, that you reached at the end of your talk. So in that, you talked about, it's not just about climate and biodiversity. I mean, obviously we have a climate emergency. We also have a biodiversity emergency. There's a lot of focus on that. There has been increasing finance from a low base going into climate, a lot of it in mitigation. We need to see more in adaptation as well. But what we're missing is this just transition. How do we integrate the social issues into the financing that's going to climate? How do we make sure that communities and the S is taken into account? So, I'm really happy with some of the great work that's been done on just transition. The UK Impact Investing Institute developed a framework as part of the G7 Impact Task Force, and they are now implementing that. But I think these kind of frameworks are really important because I think people do want to think about these things. It's just, how do you do it? I left OECD a year ago after 12 great years doing a lot of great work on impact investing, impact measurement, entrepreneurship, innovation. And now I'm really focused on working with companies and investors that are actually trying to implement, because that's where we are now. We have the tools, but what do we do and how do we do that? And when and where do you use which kind of tools? So with that, couple of things. Well, one is, first of all, you talked about leveraging all types of finance. We have a spectrum of capital that goes from the philanthropists that are giving away money and they want to have impact, and the public sector that is financing as part of their role. And then we have the private sector, the mainstream private sector that used to really try to maximize shareholder value. And now they're thinking more about, well, how do we not invest in bad things? How do we invest in good things? How do we be responsible? How do we be sustainable? And so we're seeing this whole spectrum of capital from philanthropy to mainstream finance that's really thinking about not just risk and return, but also impact. And how do we factor that in? And so important are the impact measurement tools. And you mentioned the great work, and kudos to UNDP for all the great work on the SDG investment need maps, and also on the SDG impact standards that were done alongside with OECD with my colleagues. But we, when we can really better measure impact, then the decisions don't have to be only about risk and return. We can then factor impact in as well. And investors can think about this on 3 dimensions instead of 2. And I think that will go a long way to addressing some of the issues that you raised. So the good news is we have a whole set of tools for impact measurement and management. But the problem is that a lot of people say, well, there are too many tools, so I don't know where to start, so I'm not going to do it. So I always say no more excuses, because actually the impact management platform, which came out of the impact management project, has pulled together a collaboration between the leading standard setters in impact measurement and management in the world. And this is the GRIs, the SASBs, the UNDPs, the OECDs, all of these. It's a whole acronym on soup I'm not going to get into, but they're actually working together to try to clarify what kind of tools are out there and how and when to use different tools. So there's actually a website, impactmanagementplatform.org, which will step investors and companies through when you're thinking about setting your impact strategy or you're trying to measure. You can look, read, and you can also link out to these different tools that are out there. But even more importantly, they're trying to work together to build more coherence between these different tools and potentially converge some of these tools. And in fact, that did happen. Some of the organizations that are now part of the International Sustainability Standards Board actually came out of this coalition and have actually even merged together. And now they're sitting under ISSB. So I'm very hopeful about the kind of tools that we have on impact measurement that will let investors and everyone across this spectrum of capital make decisions based on risk, return, and impact. We also have a lot of tools. When I was working at OECD, everyone was saying blending is trending. And maybe it's not trending quite enough, but it has grown, which is good news. And blended finance is really leveraging public and philanthropic capital to de-risk private sector capital and have it go where it wouldn't normally go. So it's creating, there are different ways it can be done. It can be done through specialized vehicles in which private sector investors are protected on the downside or have increased enhancement on the upside. But there are a lot of blended finance tools. The market is growing. I wish it would grow more, but it is growing, but it gets back to some of the issues that we'll come back to. Also, the impact investing market, which was nascent about 15 years ago, has grown. Jin estimates that it's now over 1 trillion. And these are investors, unlike many of the investors that are in blended finance that just want to be de-risked, but they're mainstream private sector investors. Impact investors want to have that impact. And they're willing even to maybe have a little bit less return if they can really have that impact. So they're making that impact risk return trade-off, not trade-off, but decision. And so these are really important players in the market, and that market is growing as well. We also have impact-linked finance instruments that have been developed. Many people are aware of social impact bonds, development impact bonds, but we also have a whole suite of new impact-linked finance instruments that have been created. I chair the supervisory board of the Impact-Linked Finance Fund. They've created sinks and all sorts of different kinds of instruments, impact-linked loans. So there are a lot of innovative tools that can be used. So the money is there, the innovative tools are there, the standards are there. And yet, why isn't the money moving? So we could say, well, it will move because now all these things are in place. But, do we really have all the proper incentives? And are we really helping make sure that people know how to use the tools that are out there? And the other thing is, there are many people that seem to think when you call something innovative finance, that the innovation is in the finance. The innovation is not in the finance. The innovation is actually in what you're going to do differently. Private sector is not going to flock to the table because something's called innovative finance. Actually, the more simple the finance, the better for everybody. But the innovation, and the reason it's called innovative finance, the innovation is actually in the solution. What are the organizations that are seeking the finance? What are they doing to build more effective, more efficient solutions that have more impact or lower cost? That's what's going to bring the private sector in. And I see time and time again, this is sort of a myth that people think, well, we just create innovative finance instruments and people will come. So I think we still have a ways to go in terms of, really understanding the landscape, the tools that are out there, how to use them. But I think we're really at an important inflection point, and we only have 7 years to go to the SDGs. So I hope we can really step up and leverage the tools that are there.
Well, thank you very much to the two of you for having given us not only a lot of food for thought, but a sense that things are moving and they are moving in the right direction. So I'm sure that a number of you want to ask questions, whether you are in the room or online. When you do, please ask only one question, go straight to the point, introduce yourself in one sentence so that enough people can actually take the floor. I will use my prerogative as moderator to ask you one question, which you may not want to answer right away, but maybe later on in the discussion, is to what extent do you get the sense that the energy, the innovation that is apparent in what you have said and in what is happening in that interface between the public decision makers and the private sector, to what extent do you think that it's actually percolating up, so to speak, to the intergovernmental discussions that are taking place and continue to take place, in particular in New York? And I'm thinking, of course, very much about the Summit of the Future, which is supposed to come up with some strong recommendations and action to be taken to actually reform global governance, which is, what we are talking about. So I'm just leaving that question somewhere up there, and I'm inviting the participants to take the floor. Would anyone in the room like to start, or shall we start with some of the questions that are online? And just introduce yourself very briefly.
Very briefly. So my name is Richard Bailey. I work for United Nations Office of Disaster Risk Reduction, probably UNICEF and UNDP. Question for you, Karen. You mentioned incentives, but you didn't really unpack it. I'm really interested in your take on the incentives, particularly inside the UN development system, because to my mind, they don't particularly encourage this kind of innovation and risk-taking, and many of the decision makers, in a way, kind of go in the other direction. So I'm just interested in your take a little bit more here, a bit more in terms of your thinking on these incentives and what might be done to change them. Thank you.
Would you like to take some questions, or maybe respond right away to this one?
Sure. Actually, I've seen, I'm based here in Geneva, and I've had the privilege to be able to work with a number of the international organizations here in Geneva, including the ICRC, who developed the first humanitarian impact fund and has developed a whole pipeline of innovative financing instruments. And so it's really been interesting to see more and more of the international organizations thinking about what they could do in this space, and how they can bring innovative finance to the table. That gets back to the question, to the point I made earlier. Then it's the next step of, okay, great, to have these innovative financing instruments, but actually, what does that mean for those organizations in implementation? And what has to happen differently within those organizations and the way they're doing things on the ground to actually provide the kind of incentives that the private sector would need to be willing to come in. So projects would have to be either more cost effective, or they would have to have more impact. And that would need to be demonstrated. That means that the people on the ground in the international organizations, or whoever else is delivering those services, have to do things differently. And so there can be a commitment from the top in an organization to be doing this innovative stuff. But then how do you really drive that onto the ground through these large organizations? It's not easy, as I've seen from the outside, and I'm sure many of you know even more from the inside. I think it's a combination of really needing a commitment from the top, needing some pilots and experimentation, and really finding the people on the ground that are willing to be innovative and try something different. And then once you have these success cases, then they can be scaled up more. But it's a longer process. And to be honest, my biggest frustration is the number of times I've had this conversation that I just had here, which is the innovation is not in finance, it's in what you do differently. So I'm sort of thinking we have to pull the international organizations together, not just in Geneva, but globally, because I've also had conversations with other ones, and really do a deep dive and unpack, what it really means, and, how you can then implement, and what it will take to get the private sector in. Because, the private sector, again, you have a mix of private sector players. You have those that really want to have the impact, and they're going to be the first ones in to some of these projects. But you also have the mainstream, and that's where the bigger amounts of money are. So how do you unlock that? And that's where blended finance can play an important role. But then you also have to deal with the risk and the perceived risk, which is the bigger of the two. Anyway, I think that these incentives, whether you're trying to get private sector in where they wouldn't normally go and really invest, or you're trying to de-risk them, getting the incentives right is really, really important.
Thank you very much. Alejandro, could you, I'm sorry, I cannot decipher the question on the screen.
Yes, I hope that you can hear me right. The question is from Boris Le Montagnier. Do you think we can consider the great work that happens on impact investment and different innovative finance mechanisms such as blended finance, impact-linked finance, etc., and they are about restructuring the international finance system or more about marginally adjusting small parts of the system without surely rethinking it? Thank you, Boris.
Maybe I can start and Karen, you can add. Yes, you're right in terms of posing the question, but also it gives a little bit of partially the answer. I mean, the system is complex and it has so many different levels from the very macro level to the more micro level. So impact investment, and when we're talking about these kind of financing instruments and so forth, are not in themselves going to of course, inform the financial architecture. But what they need to do is need to go hand in hand with it. So when Karen was talking about innovation and the incentives, you can't, in an isolation, incentivize part of the system and then, at the same time maintaining the rest of it. Because then you're not going to have the right policy environment, you're going to have a lot of barriers, the different financing flows are not talking to each other. So that's why we talk about, this talk is beyond just the financial architecture as we call it, but really is the system, the financial system that we operate in. So, I think also going a little bit to the incentives question, where it needs to come together is for example, for these international organizations, you talked about the myriads of UN type entities that are involved in this, is to every entity play their role and not try to play somebody else's role. But our role, for example, as international organizations, the way I see it is really to remove the barriers that is in our control, to remove that will provide some of these incentives, because the incentives are carrots and sticks, right? The sticks could be the regulations, meeting standards, and so forth. But the carrots is actually to make it easy for you. If it's difficult for the private sector to invest, unless they see an unbelievable return on investments, they're not necessarily going to bother. So they're going to channel their investments where it's easier. So they will, and they are turning away from emerging markets because it's too complicated and it's too risky, it's too unknown. Now, related to the question on the financial architecture, what we're talking about there, this is partly a response to your question, Cecile, as well. Our common agenda that the Secretary General is putting forward for the Summit of the Future is really looking at action-oriented recommendations that goes to the high level of financial architecture. It's about the global economic governance. As I said, we need to reflect on the realities of today. How is the global governance of this? How is the global economic governance distributing today? And where is the voice of those that we are trying to advance as well? It's about debt relief. It's about the international public finance, looking at the MDBs, the big banks lending and improving the borrowing terms and all of that. It's about the global financial safety nets. What are some of the macroeconomic coordination and roles that need to be strengthened across the major economies, reducing the volatility of capital outflows, etc. And finally, it's about the financial system rules. What are the rules in place? And when we have that at that level, when we talk about impact investment, incentivizing the finance sector and so forth, they will fit into that. They're not going to replace it. They're not going to get involved in the governance systems. But that's really a global system that's given. So the role that then everybody needs to play in that has to be in that context. So that's how I would make the connection of it. But Karen, you may want to add.
Yeah, if I can just build on that. Certainly the public sector, they have the most money and they have the biggest role in shaping all of this. And they have the role through the tools that you mentioned, the enabling environment, regulation, and the carrots and the sticks. But also financing wise, they are the ones with the with the deepest pockets and that have the responsibility in many ways to provide this funding. But the private sector can bring, and I think part of there was this whole mantra after the SDGs were developed about financing the SDGs and leveraging the private sector. It was almost like, well, public sector shouldn't have to do anything anymore. We just bring in the private sector to the rescue. And they're like, what? And so in reality, we need both. The private sector can bring innovation. And I think that's what's really important. So they can innovate with these different tools, these different approaches. And that's what we've seen with social impact bonds and development impact bonds. It brings innovation. If it works, the government can then scale up. So I think this is really important. So it really is a partnership between the public and private sector. It's not one versus the other. It's not one handing off to the other. It's both of them sort of stepping up and playing their role in terms of financing, but also in terms of the enabling environment and in terms of innovation. And, the question is, how do you really embed that into system? And that is tricky, but, I think their leadership is so important. So it's great that the Secretary General is planning the Summit of the Future. It's also great to see the innovative work that WTO is doing and really rethinking the trade system. And we also have to keep in mind how the trade system and the finance system, these are very interlinked. So leadership and trust and partnership and understanding, I think, is really important because it is scary for organizations to change and for people to change, right? It's easier to stick with what you know, but we really do need systems change, and we need to. So I think the summit is going to be an important inflection point on that.
Great, Alejandro, and Rebecca
Earlier, yeah.
Oh, you had your hand up earlier.
Yeah.
Please, if you can come here.
Thanks for this interesting discussion. So my name is Pekka Halla. I work also in the group, which is we're an impact fund manager, investing in emerging markets. So as an impact fund manager, we're all in for, finding the impactful SMEs, the impact ventures out there, and producing this kind of multiple value, blended value, or whatever you call it. However, our operations are fully dependent on somebody giving us money to invest. And one of the sort of bottlenecks that you can see here is that the big asset owners, the institutional investors, the BlackRocks, the pension funds out there, they operate under certain kind of limitations, not least fiduciary duty that they have, which doesn't really take into account this kind of production of blended value. And so my question is, do you see any interesting developments on that front, or do you have any ideas how we can make that, how to call it gridlock, or some kind of a blockage that seems to be there to really unlock that mass of assets towards this kind of production of impact and blended value?
Maybe we can take a few. Yeah, still interesting.
I saw that Paul, switching from this room to our virtual audience. Paul, you had a question?
Yeah, okay, great. So my name's Paul Ladd. I'm the director of the UN Research Institute for Social Development based in Geneva. And thanks very much, Agi and Karen. I'm leaving aside, I think, a segment of investments which I think only the public sector would be interested in and probably should take the lead on. I think most pragmatists, after we ushered in the SDGs, understood that we needed to get the pipework right on incentivizing private finance for the investments in the systems that would help to deliver the SDGs. So that's not in question, but I think I have less optimism and faith in the tools and standards that currently exist. When Alan White co-founded the GRI at the turn of the century, the aspiration was that for those standards to be context specific and based on thresholds. So the simplest way of saying this on the environmental side is If you read a company report that says we're using 10% water this year than we did last year, everyone claps, and that acts as an incentive for mobilizing private finance towards what's assumed to be sustainability. But actually, it's not sustainable at all if you don't know how much water is there to be used. If everyone is using 10% less water, but there's still not enough water for consumers or agriculture or other industry, then it's it's more than dangerous, because it's encouraging a large flow of money into still unsustainable activities. So whether it's the science-based targets, whether it's ISSB, whether it's GRI, I think at the moment they're acting as false cover for what we're starting to call private sector sustainable financing, and I particularly worry about that. So in the absence of frameworks that have some degree of triple materiality, then I think we're sort of misleadingly calling things sustainable finance. So I wanted to get Karen's reflection on that.
Okay, so we take a third question, and then we'll give Karen and Agi time to respond.
I'm Neil. I'm a student and a master student in international economics at the Graduate Institute. And I had a question concerning the private investments in developing countries, which you mentioned. You mentioned that the perceived risk is often greater than the actual risk. So there seems to be like a problem caused by a lack of information, or perhaps asymmetrical information, which is a shame. So there could be more investment if the information flow would be better. So my concrete question is, which financial institutions or organizations, either nationally or perhaps internationally, should really have to develop or improve their way of working to smoothen this flow of information to transfers and develop interests?
Thank you. So who will start in the responses? Maybe Karen?
I'll start, and I'll tackle the hardest one first. Thank you, Paul. You talked about the turn of the century. Well, I would go back to the previous century, and that was the beginning of the development of the measurement of financial return. We didn't have it before. It's about 100 years old. It's not perfect. We all take it as for granted. We have the accounting standards, and we think they're great, and they're science. They're not. They're improved all the time. But it took more than 100 years to get to where we are. With impact standards, it's even trickier, and it will take a while. But there's been a lot of innovation. There's been a lot of progress. GRI, as you mentioned, was one of the early ones, and they are looking at double or triple. I don't personally like these terms, but they're looking at what's material in the long term. I mean, and I don't want to get into a whole materiality discussion, because I know that that's more of a technical thing that maybe we can have offline. But anyway, I think that the International Sustainability Standards Board that was created 2 years ago, they are starting with a financial material perspective. They're looking at factors beyond finance that will be financially material to account. So you're right to say that it's misleading to call that sustainable finance in a way, because these are things that are financially material. And ISSB currently only has the mandate to look at those topics. So that includes a number of climate topics. Down the road, they'll start to incorporate more of the biodiversity, and further down the road, they'll start to incorporate more of the inequality and social issues. There's work that was done by TCFD, which is now part of the ISSB, bringing those climate standards into the ISSB. We just saw at UNGA this year the launch of TNFD, which is focused on nature. And we just in Paris last month had the initial sort of announcement about the beginning of this TISFD, which is on inequality and social issues. So this is trying to get these broader issues that go beyond what's financially material today. It's trying to get them integrated into the measurement systems in the longer in the longer term. So we're not there yet. But the reason why I'm optimistic is because I see all of this great work that's being done, and we're learning as we go. The problem is, people that aren't close to it can easily be misled. You talked earlier about greenwashing. There are people that are greenwashing either because they're sort of trying to greenwash and hope no one notices, but there are people that are greenwashing because they just also don't know. So, again, this is where I think education and training about tools that are out there is really important, but we need to keep working on these measurement tools. It's so critical. There's also a body of work, as you would be well aware, on impact monetization that would create a financial coefficient or a financial figure for impact. There are those that really think this is the answer, and there are others that are a bit more skeptical and worried because how do you boil everything down to a number? I must admit I'm in that latter camp, but a lot of really good work being done. So, maybe down the road as well, this will be something that we can use in parallel to other impact measurement management systems that give us more information to actually make decisions. Because at the end of the day, impact measurement and management is not about a number. It's about the information you get to make better decisions about allocating your resources so that you're actually having more impact. And I think that's what a lot of people miss, especially with the big focus on reporting. So reporting is sort of always going to be the minimum common denominator. Just because you're reporting the standards, the regulated standards, doesn't mean that's enough. Organizations need to measure and manage according to their own impact objectives, and there are different tools they can use, and there are more coming. But I would love to have an offline discussion with you sometime here in Geneva. Thanks.
Great.
I mean, just very briefly to this point and on the standards. Linking a little bit to what you were also asking, the role of international organizations or whose role it is to provide an enabling environment. Because when we're talking about standards that then translate to reporting and monitoring, at the end of the day, the paradigm shift, partially what we're talking about is that those who are investing are looking for these outcomes as well. But in reality, what happens a lot of the times, there is a bit of the feel-good factor. So, 20% of my investments will go to the very reportable, positive, sustainable outcomes with a lower return on my investments. And the rest, we'll just put it into something that's fast and higher return and so forth. So I think, this is kind of the shift that we need to go towards where there's a demand for that, because, generally that's the outcomes that we want to see, while absolutely recognizing this is not altruistic. Investors and the market is not altruistic. So that goes to your question about the public sector and the institutions and how we, what is the risk? What is the role in this de-risking and the enabling environment? If you think about it, for decades, a long time, Africa, everywhere, every country or most countries would have something called or similarly called the investment promotion agencies. So if you think about it, that was their role, to attract investment to the country, to make sure that the regulations are well known, facilitating that and so forth, and linking it to the objectives. So in a way, we're strengthening that notion with this to say it requires more than just one agency, because they don't have the capacity, they don't necessarily fully have the ability to link the development outcomes with investment opportunities. So what it requires is really a partnership across many players. One, the governments, where there are governments. In many cases, we have different setups, and that makes it even more complicated. So whatever authorities. But let's say we're working with the governments, and the governments are the ones who are setting the rules. So how can we help them to set the best possible rules for their context? And this is where a lot of the emerging economies, a lot of the developing countries, they simply have no capacity. So this is where they partner with international organizations such as UNDP or WTO or whatever it may be, depending on their context. The second part is the local ecosystem. You're talking about investment funds and so forth. what is also needed is that there is a more robust local ecosystem, a financial ecosystem in these countries where you have the local intermediaries, where you have the possibility for the financing sector locally to tie to a global or international kind of investment sector. So these two layers can actually talk to each other. And again, that's partially capacity development, that's partially investments from the countries. But I think the main role that international organizations can play is an advisory role. We will never be certifying certain kind of investments or bonds or criteria, taxonomies. We can help develop them, because what the market doesn't necessarily have the incentives to do is invest in these steps to de-risk. But this is where we need to blend our efforts, and it's not just international organizations, not just the governments, but we do have large-scale investment. Just to give you very specific things, we're working with something called Global Climate Fund, or the GEF funds, that are really pooled monies, pooled funding mechanisms to support climate action. How can we use these funds to provide that de-risking environment so that they can couple with private investments, and essentially these synergies creating a much larger impact than they would otherwise. So I think we need to make sure that these roles come together, the advisory role on development, the government's role of actually guiding what they want in their countries, the markets, the investments, the policies, and then the private sector who finds their right incentives in this to channel their investments, but in a way that's good for them and good for everybody. And that's a challenge. How do you find these kinds of partnerships?
Okay, Alejandro, yes, one more question.
Just a burning question to me, because when you talk about sustainability, you're talking about continuity, and you both explained the importance of the public sector. They set the rules, and of course, the importance of public partnership. You also mentioned leadership. But if we believe in democracy, governments will change, the reform barriers. Leadership will change, priorities will change. How do we guarantee that we are on the right track with leaders and those who have the biggest topics of changing in the democratic world? What do you think? What is your take on that?
I think that's part of some of the fundamental issues that are in between us as the world and achieving some of these goals. Partially, for example, what I referred to at the beginning, when governments, politicians are in place, horizon is, let's say, on average 4 years. So what are the policies they can make? And then, they may think about re-elections and so forth. So this is what we see now in many countries, that while there is a little bit of a backpedaling of policies because of the pushback of societies and because of the risk for governments to fall and fail, given the pushback of societies. So then, we get into these cycles when policies are going backwards, not forwards, even the ones that put in place, simply because they know they are not implementable in a way that would allow them to continue govern along those policies. So it's a really fine line, and sometimes a bit of dancing on eggshells to see how you take forward-looking old policies within the constraints that you have as a politician. So, not to get too political about it, but if you look around in countries where the systems may not be like that, and there's a longer planning horizon, there are countries where there's longer planning horizon, and somehow these longer term policies are easier to implement. So this is definitely a fundamental problem. And when you look at markets, it's also not exactly a long-term, most of the investments are not having a long-term horizon to it. So that's definitely, now how to get away from it. I think, number one is to have strong institutions, because institutions stay. So if you have strong institutions, you have a strong financial regulatory framework, if you have the capacities at various levels, that will survive politicians, that will survive governments. So, invest in the system that the governments, invest in the institutions that are not politicized where possible. It's not always possible. And then secondly, connect these networks so that the networks will continue to go on between the national and international, between the public and private, so that you have that continuity that you're talking about. Karen, you may have some other ideas of
No,
that.
you said it perfectly. I was going to say it's really about the institutions, the public servants, the international organizations that are doing the long-term work, that are helping to build the knowledge base, provide the recommendations. The only other thing I would add, it's really important to, especially when you're thinking, I'm speaking from the private sector finance side, to make sure that there's cross-party commitment to the efforts and to the policies put in place, because that's where you can really see things move forward. It may be that a politician comes in and they want to have their own fund, their own name, or whatever, but to make sure that the ideas have buy-in, broad buy-in, it's really important. So if you have the evidence base behind the data, the examples, the case studies, the business case, I think there's a better chance.
Yeah, maybe just to conclude with that, in terms of, you mentioned leadership before. So
Yeah.
this goes back to leadership, because at the same time, we need strong leadership at the level of political leaders who can take this agenda forward. And, that's hopefully some of the momentum will lead to that, because with that gap, it's very, very difficult to take any of these issues forward, even if you have strong institutions and so forth.
There's leadership at all levels. So there's leadership in the international organizations, even leadership on an individual level. So I think leadership is important for everyone. We all have a responsibility. So.
Right. I see there were still questions in the chat.
Question from Mohan, I think from Singapore. And there
Yeah.
was one comment from Mayuri in India. I wonder if we can take.
Are you okay with a few more minutes?
Just a few more minutes.
Yes.
Mohan, possibly
Yes.
can just present his question himself directly.
Yes.
You, Mohan.
Go ahead, Mohan, and straight.
Yeah, hi, thank you very much. I'm from Singapore. It's about 1 a.m, so I'll wait. 1:30 in the morning. It's just very quickly about the recent G7 decision at I think the Global Gateway Forum about a week ago in Brussels, where they decided to throw $600 billion into infrastructure development in South Africa. And they brought together governments, international organizations, banks, government companies to address this problem, and governments were there. It is an invitation-only meeting. Now, this seems to be more a counter to the Chinese Belt and Road Initiative, and there's no mention whatsoever, I think, in the forum or in the discussion about addressing a specific SDG number 9 in this initiative. So I don't know if you're aware of this, and if you have any thoughts about, is this another example of not taking into account how to help these African countries manage their own finance in this particular initiative? And also, as what maybe Paul and the others were saying, is to ignore the reform that is needed to finance SDGs as such. Thank you.
Mentioned, but I think, the fundamental part of it is infrastructure is an area where it really links together a number of things. It's about the trade that you were talking about, how we can do sustainable trade. It's about the infrastructure development itself, which is, one of the most energy heavy and potentially carbon heavy investments, depending on how you approach it. At the same time, it's absolutely necessary, because for a lot of the countries to be able to do any kind of development, infrastructure is key. So, in that sense, I wouldn't necessarily go into the big politics around it. But one of the things we're looking at, it is about sustainable infrastructure, and it is about decarbonizing the investments in infrastructure, which is extremely important going forward. So, some of the original comments on the Belt and Road Initiative that you quoted was exactly about that, or these investments, taking kind of the carbon-heavy avenues when it comes to infrastructure. And then there is a whole other debate out there about the debt of Africa and who they are indebted to. But that has slightly different dimensions as well. So maybe that's for our next talk. We can address those issues.
Well, thank you very much to our two speakers, and thank you very much to all of you here in Geneva and online for having asked questions which were extremely interesting. I knew before we started that it would not be possible to limit the discussions to 1 hour. You said at the beginning that it was not going to be a technical discussion, that it was going to be a discussion that could be accessed by people at different levels of knowledge about the instruments that you have mentioned. To me, it has opened a lot of avenues, and we should definitely explore the idea of having further discussions on some of the topics that you have raised. You have given us reason to hope that things are beginning to change, but at the same time, what you have said and what the participants have said is also very sobering. And in particular, of course, the emphasis on the need for leadership, which seems to be at times sorely lacking in a number of quarters. At the same time, it is very encouraging to realize that a lot of things are being done and that they are beginning to work and they are beginning to show results. So I will leave it at that. Thank you very much again. I don't know, Alejandro, as head of Gray Cells, no particular points or comments you wanted to make, or particular announcement maybe?
Well, just to thank you all, Agi and Karen, for their presentation. Just a kind of announcement, we're going to have next Tuesday, 14th of November, our next great talk. And it will be on something that at the end of the day, I think it's related. It's on social justice in the future of work. So you're all invited, and thank you very much for this session.
Thank you.
Thank you.
Thank you all.